Question 1. An insured purchased a life insurance policy and named his wife as the primary beneficiary and his daughter as the contingent beneficiary. If the insured and his wife are killed in a common accident, who will receive the policy proceeds? A. The insured's estate. B. The insured's daughter. C. The insured's wife's estate. D. The policy will be voided due to the common accident. Answer: B. The insured's daughter. When both the primary beneficiary and the insured die in a common accident, the contingent beneficiary receives the policy proceeds, assuming the primary beneficiary did not survive the insured. A contingent beneficiary serves as the next in line to receive the death benefit if the primary beneficiary is no longer living or cannot be located at the time of the insured's death. This designation is crucial for ensuring the policy proceeds are distributed according to the insured's wishes, even in unforeseen circumstances. Always designate both primary and contingent beneficiaries to avoid the death benefit going to your estate by default. Question 2. A life insurance policy's free look period in California begins on the date the policy is A. Approved by the insurer. B. Issued by the insurer. C. Delivered to the policy owner. D. Applied for by the applicant. Answer: C. Delivered to the policy owner. In California, the free look period, also known as the right to examine period, starts on the date the policy is delivered to the policy owner, not the date of issue or approval. This period gives the policy owner a specified number of days, usually 10, but 30 for seniors, to review the policy and return it for a full refund if they are not satisfied for any reason. This crucial consumer protection allows individuals to examine their insurance contract without financial penalty. Always make sure clients understand when their free look period begins and how long it lasts. Question 3. Which of the following statements regarding the incontestability clause in a life insurance policy is true? A. It prevents the insurer from denying a claim due to misstatements on the application after the policy has been in force for a specific period. B. It allows the insurer to contest the policy at any time if fraud is discovered. C. It applies only to accidental death claims. D. It gives the insured the right to cancel the policy at any time without penalty. Answer: A. It prevents the insurer from denying a claim due to misstatements on the application after the policy has been in force for a specific period. The incontestability clause in a life insurance policy generally prevents the insurer from denying a claim based on misstatements made in the application after the policy has been in force for a specific period, typically 2 years. This clause protects beneficiaries from an insurer trying to void the policy after the insured's death due to innocent misrepresentations. However, this clause typically does not apply in cases of fraudulent misstatements. Understand that this clause provides security and peace of mind for policyholders by limiting an insurer's ability to challenge a policy's validity. Question 4. All of the following are characteristics of a variable life insurance policy except A. A fixed death benefit. B. Cash value that fluctuates with investment performance. C. A death benefit that may increase or decrease based on investment performance. D. Requires a separate account for investments. Answer: A. A fixed death benefit. Variable life insurance policies are unique because their cash value and death benefit, minimum guaranteed but potentially higher, fluctuate based on the performance of the underlying separate account investments chosen by the policy owner. Unlike traditional whole life policies, variable life does not offer a fixed or guaranteed death benefit beyond a minimum, nor a fixed cash value. This ties the policy's performance directly to market conditions, offering potential for higher returns but also higher risk. Remember, the variable aspect refers to the changing nature of the cash value and death benefit due to investment performance. Question 5. In California, an insurance agent is required to provide an applicant with a buyer's guide and policy summary when selling. A. Only term life insurance. B. Only whole life insurance. C. Any type of individual life insurance. D. Only variable life insurance. Answer: C. Any type of individual life insurance. In California, agents selling individual life insurance policies are required to provide prospective purchasers with a buyer's guide and a policy summary. The buyer's guide offers generic information about different types of life insurance policies, helping consumers make informed decisions. The policy summary, on the other hand, provides specific information about the policy being considered, such as premium amounts, cash values, and surrender values, on a guaranteed and non-guaranteed basis. These disclosures are essential tools for consumer protection and transparency in the insurance marketplace. Question 6. The standard grace period for a life insurance policy in California is typically A. 7 days. B. 10 days. C. 20 days. D. 30 days. Answer: D. 30 days. In California, the standard grace period for a life insurance policy is 30 days, or 1 month. This provision allows the policy owner an extended period after the premium due date to pay the premium without the policy lapsing. If the insured dies during the grace period, the death benefit will still be paid, but the unpaid premium will be deducted from the proceeds. This grace period provides a safety net, preventing immediate policy termination due to a slight delay in premium payment. Question 7. Which of the following is not a characteristic of a modified endowment contract, MEC? A. It loses its tax-favored status for withdrawals and loans. B. It is classified as a MEC if it fails the 7-pay test. C. Distributions are subject to a last-in, first-out, LIFO, tax treatment. D. Loans and withdrawals are tax-free up to the policy's cost basis. Answer: D. Loans and withdrawals are tax-free up to the policy's cost basis. A modified endowment contract, MEC, loses the favorable tax treatment typically associated with life insurance policies, specifically regarding loans and withdrawals. If a policy fails the 7-pay test, meaning cumulative premiums paid during the first 7 years exceed the net level premium amount for a paid-up policy in 7 years, it becomes an MEC. Distributions from an MEC, including loans and withdrawals, are subject to last-in, first-out, LIFO, taxation, meaning gains are taxed first, and if taken before age 59.5, they may also incur a 10% penalty. Therefore, loans and withdrawals are not tax-free, rather, they are taxed as ordinary income and potentially penalized. Question 8. All of the following are standard exclusions in a life insurance policy except A. War. B. Aviation. C. Suicide. D. Hazardous occupation. Answer: D. Hazardous occupation. While a hazardous occupation might lead to an increased premium or a modified policy, it is generally not a standard exclusion that would void the policy in the way war, aviation, non-commercial, private, or suicide within a specific period might. Most life insurance policies include exclusions for death resulting from war or acts of war, and suicide within the first 2 years of the policy. Aviation exclusions typically apply to non-commercial pilots or specific risky aviation activities, not generally commercial airline travel. Insurers assess occupational risk during underwriting and adjust premiums accordingly, rather than entirely excluding coverage. Question 9. An agent's license in California is considered inactive when A. The agent has not sold any policies in the last 12 months. B. The agent has not completed continuing education requirements. C. The agent's appointment with an insurer has been terminated. D. The agent has not paid the license renewal fee. Answer: C. The agent's appointment with an insurer has been terminated. In California, an insurance agent's license becomes inactive if the agent is no longer appointed by an insurer. While not meeting continuing education requirements or failing to pay renewal fees can lead to license lapse or suspension, the primary factor for an agent's license to be considered inactive, but still valid, is the termination of all appointments. An inactive license means the agent cannot transact insurance business. To become active again, the agent must secure a new appointment with an insurer. Question 10. The purpose of the California Financial Services Commission, FSC, in relation to variable life products is to A. Regulate the investment aspect of variable life policies. B. Set premium rates for variable life policies. C. Oversee the marketing and advertising of all life insurance products. D. Administer the licensing exams for life insurance agents. Answer: A. Regulate the investment aspect of variable life policies. The question refers to the California Financial Services Commission, FSC, which is a common misconception or perhaps a poorly phrased question if it implies a specific California body named FSC for this purpose. In reality, variable life products, due to their investment component, are regulated as securities by the Securities and Exchange Commission, SEC, federally, and the California Department of Business Oversight, DBO, or California Department of Financial Protection and Innovation, DFPI, at the state level, in addition to being regulated as insurance by the California Department of Insurance, CDI. The core concept is that variable life policies, because they involve investments, are subject to dual regulation by both state insurance departments and state/federal securities regulators to protect consumers from investment risks. Remember, any product tied to securities performance will have an extra layer of regulatory oversight beyond typical insurance. Question 11. What is the primary purpose of the California Department of Insurance, CDI? A. To act as a consumer advocacy group for insurance policyholders. B. To develop new insurance products for the market. C. To regulate the insurance industry in California and protect consumers. D. To set premium rates for all insurance policies offered in the state. Answer: C. To regulate the insurance industry in California and protect consumers. The primary purpose of the California Department of Insurance, CDI, is to regulate the business of insurance in California, which includes licensing agents and insurers, approving policy forms and rates, and enforcing insurance laws to protect consumers. The CDI ensures that insurers operate fairly and are financially solvent to meet their obligations. Their role is to oversee the industry, not to create products or solely act as an advocacy group, though consumer protection is a key outcome of their regulatory actions. Always remember that the state insurance department is the primary authority governing insurance operations within its borders. Question 12. A policy owner cancels his universal life policy. Which of the following may be subject to taxation? A. The death benefit. B. The policy's cash value withdrawals exceeding the premiums paid. C. The entire cash value. D. The surrender charges. Answer: B. The policy's cash value withdrawals exceeding the premiums paid. When a universal life policy is surrendered, the cash value may be subject to taxation if the amount received exceeds the total premiums paid into the policy, the cost basis. This is known as the gain on the policy. The death benefit itself is generally income tax-free, and surrender charges are deductions from the cash value, not taxable income. Always remember that for life insurance, cash value growth is tax-deferred, but any gain realized upon withdrawal or surrender is taxable income. Question 13. Which rider allows an insured to purchase additional insurance at specified future dates without proof of insurability? A. Waiver of premium rider. B. Accidental death benefit rider. C. Guaranteed insurability rider. D. Cost of living rider. Answer: C. Guaranteed insurability rider. The Guaranteed Insurability Rider, GIR, allows the policy owner to purchase additional amounts of insurance coverage at predetermined intervals or specific life events, like marriage or birth of a child, without having to prove insurability. This means the insured will not be required to undergo a new medical exam or answer health questions, regardless of their health status. This rider is valuable because it protects the insured's ability to increase their coverage as life circumstances change, without worrying about becoming uninsurable. Think of it as a future-proofing option for your coverage needs. Question 14. An agent engaging in the practice of replacing an existing life insurance policy with a new one that offers no true benefit to the policy owner is committing the unfair trade practice of A. Rebating, B. Twisting, C. Churning, D. Defamation. Answer: B. Twisting. Twisting is the illegal act of inducing a policy owner to lapse, forfeit, or surrender an existing life insurance policy to replace it with a new one, to the policy owner's detriment. This practice often involves misrepresentation or incomplete comparisons of policy features. Churning is similar but involves replacing a policy within the same company by the same agent, often to generate new commissions. Twisting specifically involves replacement across different insurers. Remember, both twisting and churning are unethical and illegal practices because they prioritize agent commission over the client's best interest. Question 15. All of the following are types of term life insurance except A. Level term, B. Decreasing term, C. Increasing term, D. Modified whole life. Answer: D. Modified whole life. Modified whole life is a type of permanent life insurance, not term insurance. Term life insurance provides coverage for a specific period, the term, and does not build cash value. Level term has a fixed death benefit and premium for the term. Decreasing term has a death benefit that decreases over the term, often used for mortgage protection. Increasing term has a death benefit that increases over the term. Understanding these distinctions is key to recognizing the fundamental differences between temporary and permanent life insurance. Question 16. The period during which an annuitant receives income payments from an annuity is called the A. Accumulation period, B. Surrender period, C. Annuitization period, D. Free look period. Answer: C. Annuitization period. The annuitization period, also known as the payout or liquidation period, is the phase during which the annuitant begins to receive regular income payments from the annuity. This contrasts with the accumulation period, which is when the annuity's value grows through contributions and investment earnings. The surrender period is when penalties may apply for early withdrawals, and the free look period allows for policy cancellation shortly after delivery. Understanding these distinct phases is crucial for comprehending how annuities function as retirement income vehicles. Question 17. Which of the following is true regarding a non-contributory group life insurance plan? A. All eligible employees must participate. B. Employees contribute a portion of the premium. C. The employer is required to pay 75% of the premium. D. Employees can choose to opt out of the plan. Answer: A. All eligible employees must participate. In a non-contributory group life insurance plan, the employer pays 100% of the premium, and all eligible employees must participate. This high participation rate helps the insurer avoid adverse selection, where only high-risk individuals might choose to enroll. Conversely, a contributory plan allows employees to pay a portion of the premium and typically requires a minimum percentage, example 75%, of eligible employees to participate. Remember that the non-contributory aspect means no employee contribution, which in turn mandates full eligible participation. Question 18. An application for life insurance was submitted to an insurer without the initial premium. If the applicant dies before the policy is issued, what will happen? A. The policy will pay the death benefit because the application was submitted. B. The policy will be issued and the premium will be deducted from the death benefit. C. The policy will not be in force, and no coverage will be provided. D. The insurer will request the premium from the applicant's estate. Answer: C. The policy will not be in force, and no coverage will be provided. If an application for life insurance is submitted without the initial premium, the policy is generally not in force, and no coverage exists until the policy is delivered and the first premium is paid. Coverage typically does not begin until the insurer issues the policy and the premium is paid, unless a conditional receipt was issued with the initial premium. Without that upfront payment, there's no consideration for the contract, meaning no valid agreement was formed. Always ensure the first premium is collected to activate coverage, especially if a conditional receipt is desired. Question 19. The 7-pay test is used to determine if a life insurance policy is A. Universal life policy. B. Term life policy. C. Modified endowment contract, MEC. D. Variable life policy. Answer: C. Modified endowment contract, MEC. The 7-pay test is a specific test applied to life insurance policies to determine if they are overfunded according to IRS rules, leading to classification as a modified endowment contract, MEC. If the cumulative premiums paid into a policy during its first 7 years exceed the net level premium that would have been required to pay up the policy in 7 years, it fails the test and becomes an MEC. This classification triggers less favorable tax treatment for withdrawals and loans. It's a crucial test for understanding the tax implications of certain life insurance policies. Question 20. Which life insurance policy allows the policy owner to vary the premium payments and the death benefit amount? A. Whole life. B. Term life. C. Universal life. D. Variable whole life. Answer: C. Universal life. Universal life insurance policies offer significant flexibility, allowing the policy owner to vary both the premium payments, within certain limits, and the death benefit amount. Unlike whole life, which has fixed premiums and a guaranteed death benefit, universal life permits adjustable payments and the ability to increase or decrease the death benefit, subject to insurability for increases. This flexibility makes universal life appealing for those whose financial needs or ability to pay premiums may change over time. Question 21. What is the primary purpose of the entire contract clause in a life insurance policy? A. To allow the policy owner to make changes to the policy at any time. B. To ensure that the policy and a copy of the application constitute the entire agreement between the policy owner and the insurer. C. To prevent the insurer from denying claims for any reason. D. To define the rights and responsibilities of the beneficiary. Answer: B. To ensure that the policy and a copy of the application constitute the entire agreement between the policy owner and the insurer. The entire contract clause states that the life insurance policy itself, along with a copy of the application, if attached, constitutes the entire agreement between the policy owner and the insurer. This means that no statements made outside of these documents, such as oral agreements or other written materials, can be used to alter or contradict the terms of the policy. This clause is vital for consumer protection, as it prevents the insurer from later bringing up information not included in the contract to deny a claim. It ensures that everything legally binding is contained within one document. Question 22. In California, which of the following is considered an unfair trade practice if committed by an insurance agent? A. Offering a prospective client a free gift for attending a sales presentation, regardless of purchase. B. Charging different premiums to individuals of the same actuarial risk class. C. Providing a policy summary and buyer's guide to a client. D. Advising a client to increase their coverage based on a life event. Answer: B. Charging different premiums to individuals of the same actuarial risk class. Charging different premiums to individuals of the same actuarial risk class, often referred to as discrimination, is an unfair trade practice. Insurance premiums should be based on objective risk factors, not arbitrary differences or personal biases. Offering gifts, providing required disclosures, or advising clients on coverage needs are all legitimate practices. This prohibition ensures fairness and prevents agents from unfairly favoring or disadvantaging certain clients. Question 23. A life insurance policy dividend option that uses the dividends to purchase a small, single premium policy at the insured's attained age is called A. Paid-up additions. B. Reduction of premium. C. Cash payout. D. Accumulate at interest. Answer: A. Paid-up additions. The paid-up additions dividend option uses the policy dividends to purchase small, single premium, paid-up policies at the insured's attained age. Each small policy adds to the overall cash value and death benefit of the original policy. This option allows the policy owner to increase their coverage and cash value without paying additional out-of-pocket premiums. It's a great way to automatically grow your policy's value over time using dividends. Question 24. What is the primary characteristic of a straight life, ordinary whole life, insurance policy? A. Premiums are paid for a limited period, then the policy is paid up. B. The death benefit decreases over time. C. Premiums are level and payable for life, and the policy provides a level death benefit and cash value accumulation. D. It provides coverage for a specific term with no cash value. Answer: C. Premiums are level and payable for life, and the policy provides a level death benefit and cash value accumulation. Straight life, also known as ordinary whole life, is characterized by level premiums that are payable for the entire life of the insured, up to age 100 or beyond. In return, the policy provides a guaranteed level death benefit and builds guaranteed cash value. This differs from limited pay whole life, where premiums are paid for a limited period, or term life, which has no cash value. Remember, straight refers to the consistent, lifelong premium payments. Question 25. The policy provision that allows the policy owner to restart a lapsed policy within a certain period, usually 3 to 5 years, is known as the A. Grace period. B. Reinstatement provision. C. Non-forfeiture option. D. Automatic premium loan. Answer: B. Reinstatement provision. The reinstatement provision allows a policy owner to restore a lapsed life insurance policy, typically within a specific period, example 3 to 5 years, from the date of lapse, by paying all back premiums with interest and proving insurability. This is different from the grace period, which is a shorter window to pay a premium before the policy lapses. The reinstatement provision gives policy owners a second chance to continue their coverage without having to purchase a brand new policy at potentially higher rates.